Welcome to TheoTrade. This is Don Kaufman. Here we are. It is May 18th, 2016, the day the Fed minutes are out. And really, the trading day, well, it belongs to the bonds. Those of you that do kind of tune in and turn on a day-to-day basis here and never miss a TheoTrade report. And the reason being, it was only last week that I talked about building a short position inside of the bond market, and I was very specific on that. It was in TLT, so we're going to start off this evening looking specifically at the TLT, which ultimately imploded quite a bit today, and I will be very upfront again, as I always am with many of my positions. Today was a day filled with relative volatility. I mean, in the day here, look at this. I've got, we've got just about 3 minutes to go to the close. I've already got 18 fills on the trading day. A lot of action over here, but what I said is the day really belonged to the bonds, which imploded. I've already closed out of my bond position. So just as often as I like to discuss, opening positions, it's critically important in a day and an opportunity exists. You have to be capable of pulling the trigger and closing a given position. In this particular case, again, we opened up short positions inside of the TLT, and it was on May 11th that we actually discussed that. I've been executing trades much of last week in anticipation for what looked like, well, the bonds were going to implode, and it wasn't just the FOMC minutes that did it today. I want to be very clear about this. The bonds were already trading down pretty drastically prior to the FOMC minutes. Again, you can see this is the TLT on an intraday chart already fading, and again, we covered our bond position. For those of you that don't necessarily go out there and short products on a day-to-day basis, it ultimately means we sold right up in the neighborhood here of 131, 132. Most of it was actually covered right in and around the 129 range. Again, I myself, I did not utilize the TLT. I used the ZB, which is the 30-year U.S. Treasury bond futures. It's a contract I'm a little bit more comfortable with. It's a very clean trade. Many of you that do follow me in the chat room, we went out here and we sold the treasuries up in the 166 and 15 ticks. Listen, you're never going to catch a high, you're never going to catch a low. But we did sell the bonds over at, again, 166 and about 15 ticks. That's this neighborhood right up here. And we just covered them today, again, right in and around the upper 163 handle over there. So out of the bond trade. However, still a pretty entertaining trade. I'm going to look to sell into any major rallies in the bonds. At this point, though, and a lot of questions were coming in, hey, should I buy bonds right now? And I say this without unequivocation. Should you buy bonds right now? Absolutely not. This is extremely dangerous trade inside of the bonds. Again, the FOMC minutes today, they came out, they were a little hawkish. Okay, I don't listen to the noise of the minutes. Okay, trading, it's about order flow. It's about being able to sustain positions in the face of adversity out there, and that's exactly what we did inside of the TLT and or the ZB, going out there, selling the market, waiting for them to implode a little bit, buying them back in. There happens to be the closing bell for the day. However, we're going to continue to watch for opportunities inside of the bond market. Now, the bond markets happen to throw off a little bit of volatility inside of the broader S&Ps over here, and there were some trades that we even did on an intraday basis. Again, not everybody here that joins us and not everybody that watches TheoTrade can join us each and every day in the chat room. However, we did an intraday trade in the chat room, and I'll share that with you here momentarily. But as I said, the S&Ps today, were the victim, if you will, of what was going on inside of the bond market. And that's really been a lot of kind of my thesis lately of the markets. They're being driven and led around by the bond market, led by the nose over here. When I say some volatility, I mean you have to really start to respect the S&Ps have traded from roughly 2030 to 2057. Okay, that has all the hallmarks of volatility. Again, ever increasing ranges on a day-to-day basis. We have stopped short at this 2030 mark inside of the S&P's market. All right, 2030 is holding huge weight in the S&Ps. We're closing just about 12 points higher than that. So again, the next time we approach 2030, better respect this level, because under 2030 things could get wild in the S&Ps. We traded some decent volume out there, but as I was saying, ultimately the movement of the bonds, I say it threw off some volatility. For a marketplace that's trading right now, and so many people look at the VIX and it's a 15 or 16 VIX, which is relatively speaking a low VIX. And I will say once again, for a marketplace that has a relatively low VIX, I don't know about you, but this looks like some pretty serious intraday volatility to me. And the opportunities that exist on an intraday basis have been rather phenomenal. And I'm going to show you again an example of that. And this is not something that exists every single day, but here's that example. So during the trading day, there was an interesting opportunity when I looked at the May 18th options. And if you think about it, today is May 18th. These options expire today. This is a midweek expiration. And during the trading day, we were afforded the ability to go out and to actually purchase, okay, for a whopping $1.30. We were able to purchase the 2050 puts just prior to the FOMC announcement. Markets were setting up. Looked like it could be, a little bit of a reversal on an intraday basis over there. I base that on a number of factors, including volatility inside of the bond market. Okay, the fact the financials are so strong and energy was relatively weak over there. So we were able to actually purchase the 2050 puts for $1.30. 8 minutes later, we're able to sell them for $5.80. And this is a trade. It's done about statistics. Okay, we're taking again a shot, and this is what I'm opening up right now. If you guys have never looked over here, it just happens to be my my order book for the day. Not trading big, but I'm trading often. All right, and again, as I said, I'm working all kinds of orders throughout the course of a trading day over here. So I'm going to scroll down and show you again the statistical significance of a trade like this. And here it happens to be. So again, as I'm displaying it to you, I also filled a few other trades intermittently. So I will again highlight the specifics of this and why certain trades like this, if you do the right things again and again and again, they work. All right. So here's a trade where I go out and I actually turn around and I buy an option that is literally going to expire today. Now, not every one of you, again, can watch trade on an intraday basis, and I'm afforded the ability to do that. But, okay, at some point, most of you want to get to that level. So here we go out and we buy an option, and we buy it for $1.30. One of the big misnomers in the market is that you should sell options, right before the expiration. It's going to expire worthless. I could not disagree with that statement more. Okay, the opportunity right before an expiration is to buy an option. In this case, we went out and we paid a what? A whopping $1.30. Paid $1.30 for it. So we take this $130 bet, and that's on, one contract over there would be $130 of obviously total risk. We take a $130 bet, and it's a binary event. A binary event in the SPX ultimately means there's what? About a 50-50 shot. So when the FOMC announcement comes out, or I should say FOMC minutes come out, you take this binary event that's a 50-50 shot, and you say, well, I have a $1.30 at risk. What's the most I can do? If I'm wrong, I lose the 130. But if I'm right, and the binary event plays out, and you can actually see the sell side of this trade right in here, okay, how much longer was that? So the initial execution was at 10:53 Pacific time. The exit on the trade was 11:05. All right, so you're in a trade less, again, than 8 minutes, purchasing it for $1.30, selling it in this case for $5.80. again, in the SPX, which is a pretty big boy product, again, based on a 50-50 shot over there, don't you think that's good odds? Because 50% of the time, what do? Lose $1.30. The other 50% of the time, okay, you're making 3-4 times your money. The right trades, the right risk-reward ratio. You got to do this stuff again and again and again. And what I did on an intraday basis, this is the kind of stuff that resonates through all of the trades that we do here at TheoTrade. And it's, again, something I just wanted to stick with you. So over the next, 2 days, I fully expect, again, based on what's going on in the bond market, there's no easy way to say this. Markets are becoming substantially more volatile every single day. Every warning sign has been thrown out to you over there. The only thing we have not seen, we haven't seen, volatility start spiking. We haven't seen too much craziness to the downside inside of the S&Ps. Nevertheless, okay, the intraday ranges have been phenomenal trading ranges, okay, to be involved, getting great prices throughout the entire marketplace. It's one of the reasons I've got so many executions today, 18 orders executed throughout the course of the day. And only one of those trades that I did out of 18 executions today, only one of the trades was even an intraday trade. Everything else were positions that I was ultimately taking off in a profitable stance over there. Again, I bought back my bond position. I am looking for other opportunities to re-enter into the bond position when it's up into the 165, 166 range. We're going to hit them again. Thanks a lot, everybody, for joining us here at TheoTrade. My name is Don Kaufman. We will be back on all throughout the course of the week and for the weekend update. Have a good evening. Bye-bye.